This is Nightly Business Report with Tyler Matheson and Susie Garrett.
Collapse of an $80 billion deal. Rupert Murdoch's 21st Century Fox abandons its pursuit of Time Warner. What's next for a Fox and the prey that got away?
Sharp stumble, a lousy start to the trading day, and it got even worse. But there are ways to protect your money in this market.
Road safety, the new technologies companies are developing to cut down on the number of long-haul truck accidents and potentially save lives. The second in our three-part series, Collision Course. All that and more tonight on Nightly Business Report for Tuesday, August 5th. Good evening, everyone, and welcome. I'm Tyler Matheson.
And I'm Sue Herrera, in tonight for Susie Garrett. It was an ugly day at the open. It was even uglier at the close. However, strong earnings from Disney could change the tone tomorrow. But we begin tonight with that $80 billion deal that seems to be dead. 21st Century Fox has withdrawn its bid to acquire Time Warner. In a statement, Chairman and CEO Rupert Murdoch said Time Warner management and its board refused to engage with his company or even explore a higher offer. He also said the bid drove 21st Century Fox shares lower, undervaluing the company and upsetting too many shareholders. Fox did approve a new $6 billion stock buyback plan. Shares of Time Warner initially dropped sharply after the announcement. Fox went the other way, with shares spiking right after the news.
But is the deal really dead? Let's get some thoughts now from Tom Egan. He's a senior research analyst with the Telsey Advisory Group, and he follows media companies. Welcome, Tom. Good to have you with us, Tom. Do you believe that Mr. Murdoch is going to go away, and if permanently? And if so, why did he?
I think the deal for Time Warner is dead. You know, we weren't sure about it to begin with. We had it pegged at about a 50-50 shot, and that's essentially because the net debt leverage to EBITDA ratio was going to be too high.
You know, Tom, there are those, though, who say that basically Murdoch is raising more cash, he's going to make it a sweeter offer, and that eventually he'll be successful. Why don't you think that that's in the cards?
Well, even if you include the proceeds that they get from their sale of Sky Deutschland and Sky Italia, if the bid is 50% cash, which I think is what Time Warner needs and wants, it's still higher cash. And so the leverage still goes to above 4 times.
You know, Mr. Bucas at Time Warner has succeeded in getting his stock price up, but the cost has been perhaps selling other elements of the company, Time Warner Cable, the publishing group, Time Inc., breaking them apart. That makes Time Warner more digestible to another company. Is there another company that might find Time Warner too delicious to pass up? I'm thinking of Google.
Well, it's possible there could be an OTT or a tech company that's interested. But to us, there wasn't another media company that was going to make a bid. So to us, we saw Rupert Murdoch really negotiating against himself.
I would assume that it's going to be very important to watch the dialogue that goes back and forth as investors and analysts and shareholders basically digest what's happened late this afternoon. So what are you going to be listening for from both sides in this discussion?
Well, at Time Warner, Jeff Bucas still needs to show shareholders how he's going to, enhance values, whether that's expanding HBO internationally, whether that is improving the ratings at Turner, whether that is increasing share at Warner Brothers. So he still has to show how he can increase value. At Fox, I don't think that they're done yet. So they were willing to spend $75 to $80 billion for Time Warner. They just issued or increased authorization for share repurchases by $6 billion. There could be more to go here.
You seem to be saying, Tom, that the deal did not make financial sense for Fox, and that seems to be their conclusion at the leverage ratios that you described. Did it make business sense?
Well, I had a couple issues with that deal. For example, you're merging Warner Brothers and Fox Studios. So, I mean, Warner Brothers was about 40% of the company revenue. So what would they have done with 2 times the studio? So I'm not sure if it made complete sense to me.
All right, Tom, thank you very much. Tom Egan, Telsey Advisory Group, we appreciate your perspective tonight.
Sure.
Blowout earnings after the bell from Dow component Disney, encouraging results that could set the tone for trading on Wednesday. Disney pulled in $1.28 a share in the third quarter, the highest earnings per share in the company's history, easily beating Wall Street estimates. $12.5 billion in revenue also topped forecasts, with a huge gain from the studio division. Frozen became the highest grossing animated film ever, along with strong results at parks and resorts and in consumer products. Shares were initially higher in after-hours trading. Julia Boorstin spoke with Disney CEO Bob Iger and has her one big takeaway from the earnings.
Disney's quarterly results beating on both the top and bottom line. This on the strength of a range of Disney's businesses, especially its movie division on the strength of its Marvel franchise.
This is not only about a good movie, it's about the fact that the Marvel brand has arrived and is very healthy. And if you look ahead at Avengers 2 and Ant-Man and Captain America 3, and we just announced the sequel to Guardians, which will be 2017. The pipeline there and the pipeline across the studio is in great shape.
CEO Bob Iger also commented on what drove the Parks division higher. Parks and Resorts revenue up 8%, while operating income in that division were up 23% due to a combination of increased guest spending and higher attendance. I'm Julia Boorstin at Disney's headquarters in Burbank, California.
New day, different direction. The markets wiped out all of yesterday's gains and then some on worries that strong economic data might jolt Federal Reserve policy and jitters about escalating tensions on the border between Ukraine and Russia. Despite low trading volume and little other news, all the major averages began lower and then sold off very sharply mid-session. The Dow at one point down as much as 180 points, ended about 140 lower. The Nasdaq down by 31 and the S&P 500 off by 18. While stocks slid, oil prices went along for the ride, ending at a fresh 6-month low. West Texas crude fell nearly $1 a barrel to finish at 97.38. Bob Pisani watched today's sell-off from his perch at the floor of the New York Stock Exchange and now takes a look at what drove trading to the downside.
Stocks were modestly weaker at the open, but then stocks dropped again midday and gold rallied on comments from the Polish foreign minister that Russian units were poised to pressure or invade Ukraine. Some of the damage may also have been technical. The S&P dropped below Friday's lows and is now at the lowest levels since April. But these concerns did not just surface today. The overall trend has been poor since the end of July over concerns in the Ukraine and Europe in general, as well as concerns about higher rates in the United States. Now, several U.S. stock sectors that have been weak for days were weak again today. For example, oil stocks have been weak all month. Dow components Exxon and Chevron were both down roughly 2% today. And another Dow component, IBM, has been down 5 out of the last 6 days. It was down another roughly 1.3% today. And financials have fared poorly. Goldman Sachs and JP Morgan both down more than 1% today. The bottom line, it's been a rough start to August, traditionally one of the weaker months of the year. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And Hugh Johnson joins us now to discuss today's market action and ways you can protect your portfolio in a volatile stock market. Good to see you again, Hugh. Welcome back.
Nice to be with you.
Tyler named all the things that have been troubling the market, but you really think it comes down more to the Fed.
Yeah, I think, well, if you start this whole period when the market's arguably overvalued, and I think, common sense, Sue, suggests that that was the case. 30% move up last year, almost an 8% move up this year. Sooner or later, you've got to get a correction. Obviously, there needs to be an excuse for that. I think the excuse for that, and it's more than just an excuse, is the perception that the Federal Reserve's probably going to move up their timeline on when they're going to start to raise short-term interest rates, and that's just going to aggravate conditions. We started this period thinking the market's a little pricey or overvalued. You add that to the equation, and that's you put it all together, and that gets people running for the exits or starting to sell stocks in order to protect themselves in the event this correction turns out to be something more severe.
Let me get your reaction to two sort of counter thoughts, Hugh, if I might. One is that the market is unarguably or inarguably less overvalued now than it was 10 days or 2 weeks ago. That's number one. And number two is that if interest rates rise, as most people expect them to sometime next year, early, mid, whatever, they're rising for a good reason, not because there's a big flush of inflation coming that they need to catch. And, oh, by the way, a little inflation, Hugh, is often a good thing, isn't it?
Yeah, it sure is. I think you start the whole problem is that you start this period being a little bit overvalued. And so the question is, what's going to drive the stock market higher? And the answer is, in a rising interest rate environment, it's not going to be price earnings multiples. So then you turn your focus on the economy and earnings, and you ask, how are earnings going to be this year and next? And you come up with growth rates of something in the order of, say, 2% maybe this year, maybe a little bit more, 5%, 6% next year, and you say, you know, where's the beef? What is it that's going to drive the market? And you can't come up with anything. So you say to yourself, let's wait till things get a little bit cheaper or there's better opportunity, and that's exactly what's sort of unfolding. We're moving towards better opportunities in the market, but it's really that valuation concern.
All right, now if the volatility is going to continue, we tasked you with coming up with a couple of strategies to protect portfolios in this environment. What did you come up with, Hugh?
Well, number one is I think that whatever happens, the correction, ongoing correction, it's within the context of an ongoing bull market. So the first thing I would not do is reduce my allocation to stocks. In other words, keep a meaningful allocation to stocks unless you can't sleep at night. Then maybe you cut back a little bit, but keep a meaningful allocation to stocks. The second thing you do when times get tough is you emphasize large capitalization stocks. Stay away from mid and small capitalization stocks. They perform poorly during a correction or during a bear market. The third thing is that within the context of the stock part of your portfolio, build some defense by owning some safer sectors. At the top of that list would be healthcare. You can also add utilities and telecommunications, even though I don't like the sectors. And the final thing is look away to other markets around the world. I think you're seeing better performance from some emerging markets. That's another strategy. So these are all things you can do to keep a good allocation to equities, but build a little defense into your portfolio. Good idea right now.
Do you recommend, Hugh, that individual investors should have stop-loss orders or stop-losses in place?
You know, Tyler, most individual investors should not do that. And the reason I say that is because for myself or even individual investors, it's very hard to call short-term swings in the market. That's why I say most individual investors should ignore this correction, should ignore these short-term swings in the market, should back away from all of that kind of thing, short-term trading, and should maintain a meaningful allocation to equities and ride this out. Because in the long term, again, ongoing bull market, I think you're going to be just fine.
On that note, we'll leave it there, Hugh. Thank you very much. Hugh Johnson with Hugh Johnson Advisors. Still ahead tonight, the new technology for long-haul trucks that could keep us safer on the roads. Part 2 of our 3-part series, Collision Course, is next.
A lot of buzz on Wall Street today about the nation's income gap and its impact on the economy. The S&P Ratings Agency says the widening wealth gap is complicating the country's rebound from the Great Recession and is making the economy more prone to boom and bust cycles. Income disparity has also contributed to the S&P cutting its economic growth estimate over the next 10 years.
But despite the uneven recovery in housing, Americans are still buying homes. And CoreLogic says the prices on those homes rose again in June, up by nationwide an average of 7.5%. But those prices rose by the smallest year-over-year increase in 20 months, slowed down by a modest number of sales and more homes coming onto the market.
That's my house for sale. No. Coach catches a break, posting earnings and revenue that topped estimates, and that is where we begin tonight's focus in the market. The luxury good makers' sales were better than expected for the first time in 4 quarters, helped by strong demand in international markets, especially in China. Even though its results beat, the retailer's profit was down from a year ago, and its costs and expenses increased. Still, shares popped 4% to $35.80 for Coach. Toyota saw its profits rise. Earnings got a boost from growth in the U.S. and Europe, while sales in emerging markets were weak. The automaker did cut its vehicle forecast for 2014. Still, shares were slightly higher. 119.3 was the close there. Office Depot said its second quarter sales climbed. The company says it is continuing to benefit from its merger with OfficeMax, but higher expenses caused the company's loss to widen. Earnings and revenue did beat estimates. Despite that, the stock dropped more than 3% to finish the day at $4.94.
Groupon reported second quarter results after the bell. The Daily Deals website announced a wider loss as an increase in revenue was offset by a jump in e-commerce spending. Its third quarter revenue guidance was also at the low range of forecasts. Shares initially plunged after the close. During the regular session, though, shares were just up a fraction at $7.07. Zillow also out with a wider loss, but revenue topped analyst estimates as traffic increased and more agents used its home listing service. It also upped its full-year revenue outlook. After the bell, shares were volatile, but during the regular session, the stock was down 2.5% to $141.06. CVS Caremark had healthy earnings to report. The pharmacy operator saw its profits rise as it experienced growth in its services and retail businesses. It also upped its earnings guidance for the full year. Despite all of that, though, the shares were off just a little at $77.27. And sales at Walgreens were higher in July as strong results from its pharmacy unit helped offset weaker front-end traffic. Also, there's a report that Walgreens will buy the remaining 55% of the British drugstore chain Alliance Boots for nearly $8.5 billion. But it says it will still retain its headquarters here in the U.S. The stock fell after that announcement, then came back just a little, still closing down 4% to $69.12.
The U.S. Treasury is exploring ways to deter corporate tax inversions, and it is circumventing Congress because legislators just can't seem to get anything done to stop the practice. The Wall Street Journal reports that Treasury officials are looking into how to enforce and maybe even change IRS tax codes to prevent U.S. firms from reincorporating overseas to take advantage of lower corporate tax rates there.
It seems that long-haul, big-rig trucks are increasingly on a collision course with drivers. So what are truck makers and regulators doing to make our highways safer? Well, in the second installment of our three-part series on the safety of the nation's roads, Eamon Javers looks at the technological advances aimed at reducing truck-related accidents and deaths.
There is a serious problem on America's highways, and it's only getting worse.
Nearly 4,000 people are killed in truck accidents, and over 100,000 people are injured every single year.
A mix of operator error and faulty equipment causes these horrific accidents, but companies are actively working to improve safety on semi-trucks.
The truck will not let me go faster than him.
One of the companies banking on safety is Volvo Trucks. We visited the plant in Dublin, Virginia, where things like enhanced cruise controls and lane departure warning systems are being installed. We took a ride to see Volvo's new technology in action.
My foot's not on the accelerator.
Some of the safety technology includes setting a cruise speed that does not allow the truck to go any faster than the car in front of it.
You get some slow beeps here from the radar. As you get closer to them, it starts beeping faster and faster. If you get too close, you get the alarm.
And whenever we did get too close,
we're running up on that vehicle.
This would happen.
The truck is doing all the braking. My leg hasn't moved. In cruise, the system will completely stop the truck.
This technology very well could have saved Dan Lindner's family. Lindner's wife, mother-in-law, and 2 young sons were killed when a driver slammed into the back of the family's minivan.
The impact was so severe that they didn't know what hit him.
One of the other features Volvo installs in its trucks is intended to help truck drivers, especially those who are fatigued, stay in the right lane. And if the driver fails to turn on his blinkers and veers off,
you'll notice a little
The American Trucking Association estimates that only about 10% of all trucks on the road have some kind of active safety technology, which begs the question, why aren't all trucks required to have such safety features?
The rulemaking process is just too slow. The government needs to speed up the process of evaluating some of these opportunities.
Safety experts say organizations like the Federal Motor Carrier Safety Administration are working too slowly, but that ultimately these rules should be put in place and enforced. And Volvo is not the only company trying to stay one step ahead of the regulators. Mercedes' parent company Daimler has unveiled its autonomous truck. Mercedes wants driverless trucks on the road by 2025. Skeptics, though, say it'll be a long time before we see many of these innovations, like fully autonomous trucking, on the road. And no matter how much technology a truck has, it only mitigates the chance of a collision. Whether or not you're truly safe on the road really all comes down to who's behind the wheel.
For Nightly Business Report, I'm Eamon Javers.
And tomorrow, the final installment of our three-part series takes a look at trucking companies with safety violations that shut down only to start up again under a different name. And to read more about Eamon's series on the trucking industry, head to our website, nbr.com.
Coming up, finding the next Triple Crown contender. We'll take you inside the big business of thoroughbreds and one of the most exclusive horse auctions in the world. Tough year for Target, got a bit tougher. The retailer says expenses from the massive data breach last year will be nearly $150 million. Target is also lowering its second quarter earnings forecast, citing promotional markdowns at its U.S. stores and soft sales up north in Canada. That sent shares lower by almost 4.5%.
There's a big money battle brewing over some dollar stores. Bloomberg News reporting that Dollar General is exploring a bid to buy out rival retailer Family Dollar. But you might recall that another competitor, Dollar Tree, is already in talks to acquire Family Dollar for $8.5 billion. While Dollar General evaluates its options, this could mean a bidding war might develop. USA Today publisher Gannett is paying nearly $2 billion for the rest of Cars.com that it doesn't already own. Gannett also announced plans to split into two publicly traded companies, one for broadcasting and digital properties, the other for print media. CEO Garcia Martorell says that it's all part of Gannett's long-range plans.
We have been on a transformation journey for the last 2.5 years. We have stabilized and revitalized our publishing business. We've doubled our broadcasting portfolio. We've doubled it with the acquisition of Cars.com, our digital portfolio. So we have great businesses of great scale.
Well, shares of Gannett nonetheless fell nearly 1.5% today.
T-Mobile, the fourth biggest wireless carrier in the United States, reportedly now plans to reject a $15 billion majority stake offer from France's fourth biggest mobile carrier, a company called Iliad. That rejection could come as soon as tomorrow, say reports. T-Mobile's parent company, Deutsche Telekom, views the offer as too low.
Did you ever wonder where all those elite racehorses you see in the Kentucky Derby or the Preakness come from? Most of them are bred from past winners, and many of them are bought and sold at the annual Saratoga Horse Sale in upstate New York, now in its 97th year. So what horses are on the auction block and who's doing the buying? Morgan Brennan has that story.
Your stat 45,000 your way. Thank you. Every August, billionaires, celebrities, and royalty from around the world flock to Saratoga Springs to take part in one of the most exclusive horse auctions in the world. Here, more than $30 million changes hands as the next generation of premier racehorses is bought and sold. One-year-old thoroughbreds that are virtually untrained and untested on the track, but bred from the sport's biggest winners.
This is a very special sale, to start with that. It's a select group of yearlings, so it's a very high-end group of yearlings. The average horse will bring $300,000 here. So this is not an average situation to start with.
A long line of champions have come from this auction, from this year's Belmont Stakes winner Tonalist all the way back to Manowar, widely considered the greatest racehorse in U.S. history. Buyers examine pedigree and athleticism, choosing a horse they hope can bring them not just wins, but also return on their investment.
I'm really careful about my investments, but if I'm patient, they can really pay off in the long term.
Big money, bigger dreams.
If you love the beauty of the horse and you love the sport, when they cross the line in front, there's nothing really better.
As the ultimate discretionary purchase, the horse business and the economy are closely tied together.
The stock market leads the horse business by 6 to 12 months. And when Lehman went down in 2008, the horse business felt it in 2009. Right now, it's coming back to almost back to 2007 levels.
But the so-called bloodstock business is rife with other risks as well. Many horses don't perform according to expectations despite those top genes and top trainers. And still more fall victim to injury.
It's a great way to make $1 million if you start with 10. But now we're making money and I like it better.
And that's what keeps racing enthusiasts coming back. All of them hoping that when the gavel falls at auction, they're taking home the next great racing champion. For Nightly Business Report, I'm Morgan Brennan in Saratoga Springs, New York.
And finally tonight, the people have spoken. Susie is out rehabilitating her foot after some surgery, and on our website, we asked you, our viewers, to choose the color of her cast, and you voted for pink.
Pink. There you go.
She listened. You spoke. She listened. Gareb, a woman of the people, always looking stylish. Pretty in pink.
Now her biggest chore is going to be color coordinating the outfit.
The wardrobe
with
the pink shoe.
Yep, you got to do that. Absolutely.
All right.
Susie's going to be back very soon, by the way. On that note, that does it for Nightly Business Report for tonight. I'm Sue Herrera in for Susie. Thanks for joining us.
And I'm Tyler Mathisen. We'll see you tomorrow. I'm Tyler Mathisen with a Nightly Business Report news brief. Rupert Murdoch's 21st Century Fox withdrew its $80 billion bid to acquire Time Warner, saying that company's board and management refused to engage with Fox or even explore a higher offer. Blowout earnings after the bell from Disney. It got a boost from hit movies like Frozen and huge ticket sales at its parks and resorts and strong sales of consumer products. Stocks sold off sharply today on worries about escalating aggression by Russia and whether strong manufacturing and services data could impact Federal Reserve monetary policy. The Dow down as much as 180 points, ended about 140 lower. The Nasdaq down by 31 and the S&P off by 18. Crude oil fell nearly $1 a barrel, finishing at a fresh 6-month low. And tune in to Nightly Business Report here on your public television station.